So joining me now with more on this market and what it means for you is Michael Reinking. He's a senior market strategist at the New York Stock Exchange. Michael, there has been no shortage of headlines for our viewers to digest, and certainly traders down there on the floor the past few months. What do we need to know?
Absolutely. Well, thanks for having me back on. Good to see you again. Look, it's been a very volatile period, right? We've seen, call it a 10% decline in the S&P 500 over the last month from, kind of on a peak to trough decline.
Yes.
We're coming off of 4 consecutive, kind of weekly declines.
Yes.
And this week we're kind of hovering around unchanged. And we had the big, kind of Fed rate decision yesterday.
Yeah.
As widely expected, they left rates unchanged.
Yep.
But there were some surprises that kind of came, along with, kind of yesterday's announcement. And then we also are kind of sitting right ahead of a very big liquidity event tomorrow as we have triple witch expiration and the S&P quarterly index rebalances. If you look back to when this occurred in December, you had about 4 billion shares trade here on the New York Stock Exchange and about $250 billion of notional value, one of the largest trading days in history.
So that's probably about 4 times average, right?
Yeah, but it's a very big day.
Now, what does that mean, though? We'll see more volume. We anticipate more volume, but do these indexes typically move in a certain way when something like this happens?
It really depends on where positioning is, and I don't want to get too wonky in terms of kind of options positioning. But it does seem like right now at the levels that we're at, we're seeing something called negative gamma, where as markets move in one direction, the dealer community or the street needs to hedge in that same direction. So as markets move lower, they're generally a seller. As markets move higher, they're generally buying. So it's exacerbating some of that volatility here in the near term.
I see. So is there a certain direction that you anticipate the markets might move?
I think right now the S&P 500 is sitting just below some pretty key technical levels, right? So we just had this major sell-off.
Yep.
We're kind of trying to find our footing here. The first level for the index that's really important to the upside is around 5750. That's the 200-day moving average.
Yes.
Right. That would give you a sense that you're seeing some buying on the back end of this kind of most recent bounce.
Let's talk about the word transitory, right? Because I think that might be one of the biggest takeaways from that presser yesterday. We heard transitory in September 2021 from the Fed chair. That was the case with inflation. We know how that played out. So how should we interpret it this time around when he said inflation does look transitory when it comes to recent tariff impact?
Yeah, and I think, as I highlighted, there were a couple surprises. That was, I think, the one that raised a lot of eyebrows, right? To hear team transitory kind of come back during the press conference.
That word.
Yeah, and I think that was really the expectation that had been removed from the vocabulary of the Federal Reserve, and to hear him say that yesterday was very interesting. I mean, what they're suggesting is that their base case is if the tariffs will have a short-term one-time impact to inflation, that they're going to look through that. Theoretically, that's kind of leans a little bit kind of on the dovish side of things. But I think one of the other major things that he was telling us yesterday is that the situation is just so fluid, and that they have very little certainty in terms of kind of how the environment is going to change.
So I think what was notable, I think you did a good job of explaining that, Michael. I was watching the Fed decision as well. Is that he did say that when it would be needed, the Fed could act pretty quickly, right? And so I think for viewers watching, we've seen that play out, right? How dramatically, for instance, at the beginning of COVID, the market sold off and rates went to historic lows, and we saw a pretty sharp bounce back that I think maybe would have caught the average viewer, perhaps for the show, off guard. So what capacity and tools does the Fed have if we do see a further drawback in the market?
Yeah, I mean, so the main tool that they're going to use is monetary policy and cutting of interest rates. Now, the other side of that is the quantitative easing or tightening. And we also got an announcement on that yesterday, right, where the Fed said that they were going to cap the amount of treasuries that they were going to allow to run off the balance sheet. So that was the second reduction. So quantitative tightening, it has a negative impact on liquidity, right? So The other thing that they could do is go back to quantitative easing, where they could start buying Treasury securities outright, which would also help to push rates lower.
So let's talk about the outlook, though, because the Fed chair did take GDP growth down to 1.7% and boosted inflation to 2.8%.
Yes.
There's been a lot of conversation around stagflation. What kind of picture does that paint?
Yeah, I mean, and that's exactly what they painted in their summary of economic projections, right? And it was this stagflationary period. But what they kind of continue to do is suggest that they see inflation moving back to target, kind of in 2027, a little bit lower than, a little bit longer than they had previously expected. But that is kind of the difficult message that the Fed is trying to deliver, and they're also telling you that they have very little confidence in those projections.
So it's the first day of spring, March 20th. The first quarter is going to wrap before we know it here, Michael. As we look ahead to the second quarter, that tariff pause date, April 2nd, the start of the second quarter. What should our viewers expect when it comes to the markets in Q2?
Yeah, I mean, and this has been, kind of really a big area of uncertainty for the markets, right? And so we're waiting to hear kind of what the next step is. We've seen kind of a little bit of a change in the delivery method by the administration over the last week or so. We're not hearing kind of tariffs by tweets anymore, and the administration's gotten a little bit tightened up the communication.
Yes,
there's some hope that you could start to see some kind of more back and forth kind of negotiations that are happening behind the scenes here. Even this morning, as you had highlighted, before we came on, there are some signs that the EU has pushed out their retaliatory tariffs.
Right.
This morning, the ECB, one of the things that kind of weighed on markets this morning, notably, was ECB Lagarde said that by their analysis, that if the U.S. tariffs were instituted, that would be a drag of 0.3% on EU GDP, and if there was retaliation, that could drag, that would be about a 0.5% drag on GDP. So that was part of the weakness that we saw this morning.
All right, Michael Reinking, Senior Market Strategist at the Stock Exchange. Always good to hear from Michael, especially after these Fed decisions. Thank you.
Thanks for having me.
It's great to have you.